Hello and welcome to Market Domination. I'm Josh Lipton, live from our New York headquarters. There's just an hour to go now until the closing bell, and stocks are in the red here as Wall Street weighs uncertainty over the Iran negotiations and also assesses Fed Chair appointee Kevin Warsh's confirmation hearing. More on the key points from Warsh's hearing. Let's get to Yahoo Finance's Jennifer Schonberg. Jen.
Hey there, Josh. Good afternoon to you. Federal Reserve Chair nominee Kevin Warsh told Senate lawmakers this morning that he did not pre-commit to President Trump to lower interest rates in order to get the nomination to be the head of the central bank.
The president never asked me to predetermine, commit, fix, decide on any interest rate decision in any of our discussions. Nor would I ever agree to do so.
So the president has never sat you down, looked you in the eye, and said, here's the deal, Scooter, I'm going to appoint you, but you got to agree to lower interest rates. That didn't happen, or did happen?
The president never once asked me to commit to any particular interest rate decision, period, and nor would I ever agree to do so if he had, but he never did.
When it comes to policy, Warsh says the U.S. economy is still dealing with ripples of a spike of inflation in the post-pandemic era from 2021 to 2022, saying that the Fed missed the mark. Though he says the underlying trend for inflation right now looks, quote, that it's somewhat improving and looks, quote, quite favorable if measured using a trimmed mean version of inflation that would account for one-off spikes in prices for things like food, energy, or other items that may be out of whack. Now, we didn't get a clear answer on whether Warsh still supports the notion that AI will boost productivity, serving to push down inflation and allowing the Fed to cut interest rates. Warsh suggesting only that over time, the increase in productivity from AI could help the Fed push down prices, but that there are also implications for the job side of the Fed's dual mandate, and that the Fed needs to take that into account when setting policy. Now, he also called for fundamental policy reforms to fix what he says policy errors. He says the Fed needs a new inflation framework. He reaffirmed that he believes the Fed's balance sheet is too large, and if appointed and confirmed, that he would look to shrink that. He thinks that if the Fed had a smaller balance sheet, then inflation would be better and interest rates would be lower. Warsh also called for new communications as well. He did not commit to holding a press conference post every FOMC meeting, as has been customary under the last couple of Fed chairs. He said that also relying too much on this notion of forward guidance has served as a trap for Fed officials. He actually laid that at the feet of Fed officials for the policy error that he sees that he saw in 2021 and 2022 in terms of missing the spike of inflation. He seemed to also indicate that he thinks that Fed officials speak too much and too frequently, and that they shouldn't telegraph ahead of policy meetings what they're going to do, but rather they should go into a policy meeting, have a hearty discussion, and decide in that meeting what they're going to do with interest rates. So, Josh, if indeed Warsh is going to be confirmed, perhaps we could see a bit of a return to the Greenspan era, where there is less frequent communication, the possibility of fewer press conferences, and you have to wonder if he's going to convince other members of the committee to do away with that so-called dot plot. Back to you.
And Jen, when can we expect a vote on Warsh's hearing? What's the timeline there?
Yeah, so Josh, at this point, there is no pathway forward for confirmation. This was a first step, but they are not able to hold a vote at this time because they don't have the votes. Senator Tom Tillis, who is a Republican who sits on that Senate Banking Committee, reaffirmed today that he still intends to block the confirmation until the investigation by the Justice Department into Chair Powell is resolved. He, though, did indicate that there could be an off-ramp if Republicans in the Senate could actually hold an investigation into the Fed's renovations of its headquarters here in Washington. Of course, there would have to be a lot of discussions. But again, just a first step at this point today with this hearing, no timing on when we could see a vote.
All right. Thank you, Jen. Well, for more on the fate of the Fed, let's welcome in now Thomas Hoenig, Mercatus Center Distinguished Senior Fellow and former Kansas City Federal Reserve Bank President and CEO. Thomas, it's always great to have you on the show. So let's start, Thomas, with Kevin Warsh's testimony there on Capitol Hill. Fed independence, sure. Thomas, was front and center as a topic, as a subject. And Warsh is saying, listen, I'm independent, but we also know what President Trump wants. He's made this very clear. He wants rate cuts. So how does this actually play out, Thomas?
Well, I don't think it plays out to Kevin's advantage, no matter what way we go, because as soon as he's confirmed, the president will expect a rate cut. I don't necessarily think Kevin has promised that, but that's made very clear by the president. And so let's say that Kevin has a very good reason to lower rates. If he does so, those who oppose him will immediately scream that he is pandering to the president, that he isn't independent, and that will go play very large because that'll be the first issue up for Kevin. On the other hand, if he doesn't lower interest rates, and he has very good reasons, the president will be very angry and will express it to him and publicly very strongly. So he will be gone after either way that they move. And even if Kevin doesn't do anything, the president will be upset. So he has a tough first week in office.
Yeah, that doesn't sound great, Thomas. So you're saying if he cuts, he's political. If he doesn't cuts, he's vilified by the leader of the free world. So what is his best option then, Thomas?
Well, his best option is to do what he thinks and what the FOMC is willing to go along with in terms of the right policy. And if the right policy is not to cut rates, then that's what he should do, because in the long run, that will be best remembered about him. On the other hand, if he does, and if he thinks he absolutely must, because of the conditions in the economy, cut rates, then that would be the right decision. So that's how I would look at it, and I'm hoping that's how he looks at it. Although you don't know until you're in that seat, and we won't know until he actually confronts that problem. But he is going to be vilified either way.
Would you be cutting, Thomas, in 2026?
No, I would not. At the moment, if you think about it for a moment, the economy is really stronger in the sense of activity than people might have thought. Number one, we had additional tax cuts at the beginning of the year, a tax cut extension in the beginning of the year. Those are taking effect. Secondly, we have our real interest rates. If the policy rate is 3.5%, inflation 3%, real policy interest rates are less than 1%. And I cannot imagine that would be the equilibrium rate, given the demand in the economy, given the demand for Treasury debt and the supply of Treasury debt that's in there. That puts upward pressure on interest rates. So I think it would be inflationary to, in a sense, confirm an easy policy by lowering rates further yet.
Thomas, let's also talk about the Fed's balance sheet, because Warsh wants to shrink it. And I'm just curious what you make of that. And, Thomas, how you think financial markets would respond and react.
Well, I think I totally agree with Kevin on this. I think that the balance sheet should be brought under control again. It is significantly larger, as he pointed out, than it was when he first was a governor. And that's a problem. And one of the things it's done is the Fed's willingness to buy government debt, buy government securities and securities generally, blowing up its balance sheet has led to an expectation that the Fed will monetize the debt. And that's, I think, a very bad situation for the Fed to be in. And so they need to put a stop to it. But right now, even since December of this year, they've begun growing their balance sheet again. So he's going to be entering office at the very time the Fed has re-engaged in quantitative easing, and he has to not only deal with that and stop the balance sheet from growing, but then he has to, on top of that, try and shrink it. That's going to be a long process. And if he does it too quickly, as he acknowledged in his testimony today, he will derail the financial markets. As you pull back on reserves quickly, that would cause interest rates to rise quickly and slow the economy, and really, I think, put the economy in a straitjacket for a while.
Thomas Warsh has been a very, of course, public vocal critic of the Fed in a lot of ways. And one central criticism he seems to have is he basically thinks, he says to the Fed, listen, you all need to stay in your lane, even as sort of the Fed expands its role. I'm just curious what you make of that criticism.
It's a valid criticism. I think the Fed has, in each crisis, gone outside its immediate powers in terms of monetary policy. It has bailed out not only large banks, but it's bailed out other financial institutions, even hedge funds. It has backed the capital markets. That's the market's role, and the Fed provides backup liquidity to the banking system, which then provides liquidity. So it has really broadened its so-called mandate in terms of financial crisis management. And I think that's led to an expectation that the Fed will always step in. And that means the moral hazard issues in the economy are growing. Kevin knows that. I know that. I think most people know that. And so to rein that in will take a lot of stamina on the FOMC's part to say, no, we're not going to do that this time. I think it will be very difficult for them to say no.
Warsh has been a public vocal critic, Thomas, and now he goes and, he's going to work with the very people he's been so sharply criticizing. And I'm just wondering, listen, as a former Fed guy on a personal level, how do you see that working out?
Well, I don't think it'll be that difficult for him. The FOMC generally works well together. They don't get personal as much as some other institutions might. I think he can work through that, number one. Number two, he is the chairman, and most of the members will respect that and try and work with him. However, I think his main problem is he has to convince them of the changes that he would like to make, because it is a board of 7 members at the Board of Governors, and it is a committee of 12 voters and 19 participants at the FOMC. So he doesn't want to alienate them, but he does need to lead them, and he has to be very careful in doing that, or he will get a negative reaction from them. So he has his challenges ahead.
Last question, Thomas. One area where I know you think Warsh could have a real impact, make a real change, would be ending forward guidance. Just explain that, Thomas, and what that would potentially mean for investors listening right now.
Well, I think forward guidance, I agree with Kevin. I've criticized it since it began, because it says we are going to do certain things, and you can put all kinds of contingencies, unless things change and so forth in that. But when you put down your forecast, and when you give forward guidance in terms of we are going to remain, for example, early on after the COVID crisis, the FOMC and Powell as a leader said, we're not even thinking about raising interest rates. You set expectations in the market, and once you do that, the market behaves accordingly, and banks take on longer term assets like 10-year and 20-year and 30-year treasury bonds. And then you say, oh, wait a minute, inflation's higher than I thought. And it's rising quickly. It's now 9%. We have to raise rates significantly. And you have all these institutions that have gone long, you will put them underwater. So forward guidance is a very dangerous thing, because it forces you to either change your mind and surprise everyone, or to follow through, which often is the case, and therefore worse in your own case for staunching inflation in the early stages. So I think getting rid of forward guidance would be maybe one of his easiest things to do, given the FOMC's own desires, and probably would do the most good, or would do a lot of good, not the most good.
Thomas, as always, great to have you on the show. Thank you, sir.
Thanks for having me. It's been fun. Take care.
Let's check in on the market reaction to Fed Chair nominee Kevin Warsh's hearing on the Hill.
You too now.
For that, we have Ross Mayfield, Baird Investment Strategist. Ross, great to see you, especially on set. Let's start with Kevin Warsh's testimony. You were listening to that. What'd you make of it? Any surprises for you?
To me, the big surprise is that there were no surprises. This is as close to a soft landing for a Fed pick as you could have, right? It's a a nominee who is dovish, but for economic reasons, right? The potential for AI to lead to a productivity boom and potentially weaken the labor market. It's someone who is maybe seen as close to the Trump administration, but not as close as some other candidates. And it's a person who repeatedly today stressed Fed independence and made some suggestions that, as you just heard, would be welcomed by some board members and former governors. So I think it's a home run. Obviously there's going to be fierce critics, as there always are. But I think it's about the best case scenario for market participants when thinking about the Fed going forward.
What are your expectations for the Fed this year? Like, what's base case for cuts?
I think one cut in the second half of the year. I think that's baked into markets. I'm really glad that we've pulled back from expecting a pivot to hikes here. I think hiking into an energy crisis is a huge policy mistake. But as was mentioned earlier, we're probably pretty close to the neutral rate. You could quibble with 25 basis points here or there, but I think the Fed has done most of the work to ease financial conditions and loosen things up. And we have fiscal policy working overtime as well. So I don't think the Fed needs to cut to support markets. But I do think the labor market weakness is a reason that we might get one more cut in the back half of the year. But I don't see a reason to rush either.
I'm looking at the markets here. You can just edging lower. You see oil rising. Maybe some new questions about the state of the Iran negotiations. Reportedly, Vance's trip is on hold. How should investors be thinking about this?
Well, the headline drama, the policy by tweet, I mean, that is a thing that investors have gotten used to, have gotten accustomed to. And so I don't think a little bit of weakness or upside based on the headlines coming out of Iran are going to spook anyone. I would say that it's very hard to get too defensive in a market like this when, if the market starts to weaken, the administration can say, we're ending this thing, we're coming to the table, we're making a ceasefire. So if you're too defensive or if you're short, you risk getting your face ripped off. So I think that it makes a lot of sense that the market is taking a breather here, a little period of consolidation, probably some profit taking, people who are way up versus 2 weeks ago and didn't think they'd be here. But we've seen a tremendous rally off the March 30th lows. A little consolidation, whether it has to do with this oil news or not, I think makes sense and is probably healthy. You
make a point here. It's interesting. You say conflicts like this, they tend to reinforce trends already in place. They typically, you're saying, don't create new ones. Just explain that. And then, I guess, Ross, what trends you see being reinforced?
Yeah, absolutely. And I'll give credit where credit is due. That's a quote from our partners at Strategas, Chris Ferrone. They do great work over there. And they have been proponents of this over the years where, coming into the crisis with Iran, we had real economy stocks working. We had small caps working. We had a split tech market where semis and hardware were vastly outperforming software. And we had a market where international was leadership, right? We had Japan, Korea, Europe, a lot of international stocks were outperforming US. Over the last several weeks, we've seen much of the same. The transports are making new highs. Semi and hardware is gone vertical, basically, and small caps have resumed leadership. International, as much as the economies of other countries are maybe more at risk from an oil crisis in the Middle East, those stocks are trading back near all-time highs if you look at Korea, Japan. So I think those are the kinds of things that, presuming directionally we're on the right side of this conflict, and the market seems to have completely looked past this at this point. We expect things like that to resume leadership, and that's bull market sort of stuff right there, is that cyclical leadership, broad participation, small caps working.
Let's talk about big tech, because you get some earnings this week, then it really ramps next week. You argue, listen, as for that AI trading trend, you say AI is not a bubble, not a bubble. So I guess first I'm curious, right? First define bubble.
Sure.
And then secondly, why are you so sure we're not in one?
Yeah, so the first point is so important. I mean, people can argue past each other all the time because there's not a Webster's definition of market bubble, right? You kind of have to come into it with the definition, and I think that's really important. To us, a bubble comes with a couple things. One is price appreciation, right? You look at the late 90s bubble, you look at any true bubble throughout history when we do the postmortems, and you get price action that is far past a bull market, right? In the late 90s, the Nasdaq doubled in the last 5 months of that after having gone up some 400% into that. So price appreciation that moves way past a normal bull market. We're just not there yet. And then the big thing for a bubble, differentiating a bubble and a bull market, is sentiment. It's IPOs doubling on their first day. It's euphoria. It's profitless tech. It's pre-revenue, pre-product tech taking off and going vertical. And we see that in pockets here, right? There are meme stocks and little bubbles maybe in the quantum space at times. But the general sentiment in the market had gotten pretty bearish during the depths of the Iran situation. But the skepticism of AI is far different from the enthusiasm for the .com, the .com boom. So I think that we could still get there. We've got some big IPOs coming this year. Certainly the move in tech over the last couple of weeks starts to kind of tickle a little bit, but I don't think we're nearly there yet. And you start with the simplest thing of all, which is price appreciation. Strong bull market so far, not even close to what a bubble looks like in my opinion.
Finally, in terms of just where you see opportunity on a sector level, why the industrials? What's driving that?
Man, well, coming into the year, so again, real economy stocks working. I think the industrials technically are in a good spot. So it's, from a near-term play, you've got good participation. I think two things really stand out. Very diverse sector. So a stock picker's dream, right? You've got everything from aerospace and defense to construction and machinery. So you can really pick your spots. Secular tailwinds, right? So reshoring, all of the business provisions in the OBBBA, helping to spur, building factories, building data centers, right? This is kind of stuff that construction machinery names really take off on. And then aerospace and defense, right? We know that every country in the world is being pressured to spend more and more on their own defense sector. US companies are at the center of that. So there's a lot to like. There are secular and structural tailwinds there that if it's not the best performing over the next 3 months, sure, but I think we'll keep that sector at the top of the table for the foreseeable future.
And just on the flip side, you don't like staples. How come?
Well, they're the defensive sector. They don't bring a lot of growth to the table. In a bull market and a boom, that's a tough sell. And they didn't really offer a ton of defense in the sell-off, right? They didn't do what utilities did. And when you get money markets and treasuries yielding, 3, 4, 5%, I think it's really tough to make the case for a low growth sector where the dividend yield is okay, that isn't providing a ton of upside in down markets. And, quite frankly, the consumer is pretty bifurcated, and some of those staples areas are losing weight in compared to like hotels and leisure, some of the discretionary sectors. So I find it hard to get on board with staples here.
All right, Ross, great to see you.
Yeah, thanks for having me. Appreciate that.
Coming up, Yahoo Finance tech editor Dan Howley laying out everything he knows about Apple's next CEO. Don't go anywhere. Apple is entering a major leadership transition. Tim Cook stepping down as CEO and handing the reins to longtime hardware chief John Ternus. Ternus stepping into the top job at a time where pressure is building around AI and finding the next big product beyond the iPhone. Joining me now is Yahoo Finance tech editor Dan Howley. Dan.
Yeah, this is obviously a huge move for Apple, hiring Ternus at a time where AI is really kind of just front and center for everyone in tech. I mean, this isn't a slight transition in the industry. Obviously, it's a massive sea change for what we're seeing. And so for Ternus to come in, a hardware guy, kind of gives you an inkling as to what we could see down the line for Apple. And that includes everything from AI-based hardware. Smart glass is obviously something that Apple has been kind of bandying about, or rumors rather. Bloomberg's Mark Gurman says a pendant, perhaps a camera-equipped pendant. I don't know. We'll see what, if people actually want that. The first couple have not done well, but we'll see. But it's one of the more interesting things, just in the sense that this is a 50-year-old guy, so several years younger than Cook. He first joined in 2001, so he spent his large chunk, the vast majority of his career, at Apple. He started out in hardware design in the product design team, moved his way up to senior vice president of hardware engineering. He's had his hands on the AirPods, the iPhone, the Mac. His first thing was the Apple Cinema display, and he said during a commencement speech or a keynote speech at a university that he went and fought the supplier for the screws for that Apple Cinema display because he wanted a certain set of notches in the screws, and they were not providing that. So that kind of insight into his kind of thinking gives you a better idea of who he could be as a leader. And
such an
like
Apple thing you're mentioning, by the way. This obsessive with detail.
Exactly.
Yeah.
And that clearly is something that they value. They saw that with Cook. Obviously, he used that to help grow the company, $4 trillion. I know a lot of people have said that Cook didn't do anything as far as mind-blowing products. He helped launch the second largest segment that the company now relies on, services, turning it into the juggernaut that it is today, $100 billion plus revenue. You have Apple TV Plus, Apple Music Plus, Fitness Plus, the new iCloud offerings. And so, that's something I think that, it was about scaling the company more at that point, I think, to this. I don't even think they thought it was going to get that big, right? To now, okay, we're this large company. How do we push that beyond, right? We don't know what AI is going to do for devices. Is it going to be similar to how search kind of upended everything? Where Apple was able to just say, all right, well, we'll license out to Google. We'll use them for search. What does that mean? They are obviously going to be licensing some of Google's AI models for Siri, but I think it's still very much up in the air what this means for actual device makers. I know we see companies putting AI in everything, right? We have the Microsoft AI PCs or AI Copilot Plus PCs. We have Google talking about how they have AI built into their devices, and yeah, it's helpful. It really is. As long as it's not in your face, I think it's very helpful.
And for all the questions, Dan, the iPhone franchise continues to perform well.
Well, that's the other thing, right? They just had a record quarter, right? They continue to sell, a ridiculous amount of iPhones. So much so, in fact, that they had a lot of pull-through that they weren't expecting. And so they may have to build back up that inventory they were saying in their prior quarter. So I think there's a lot of, what is Apple going to do next? This discussion has been going on for, almost as long as I've been writing about technology, right? Like, what's the next thing for Apple? I think it's important now because next year will be the 20th anniversary of the debut of the iPhone. 2007 was when it debuted, Steve Jobs showing it off. It does feel as though, 20 years is a long time. And granted, we still have laptops. I'm sitting here with an Apple laptop, right? Those are, very old as well. But what I think the market and people are wondering, okay, cool, what's this next thing? Will it be the foldable? Will that really kind of take off? Is it going to be glasses? Is it going to be a pin? I'm not banking on the pin. I think that's dumb. I think it's the dumbest thing. I'm not going to wear a pin all day. I don't need, whatever. I don't need to see anyway. Just going to like Wendy's or something. But I do want to see where these products go. To me, something without a screen doesn't make sense. Is it going to be glasses? I already see people with a Meta glass. It's kind of weird. My wife was on vacation with it, and I was like, when are you recording me? When are you not? This is my wife, right? So I don't know. That's my rant. I'd like to see where this goes, but I think that the big thing about Apple and Turnus for now is that he is inheriting a company in incredible shape. He is a guy who's been inside. We were just discussing culture is a large thing for Apple. And so, by all measures, he's lined up for success. We just have to see what the next iPhone will be.
All right, Dan, thank you, buddy. Appreciate it. Well, Tim Cook is stepping down, and longtime hardware chief John Turnus is taking over as CEO in September. It's a major moment for the company as it looks to balance the legacy of operational excellence under Cook with growing pressure to move faster on AI and deliver the next wave of breakthrough products. For more, I want to bring in now Ramon Lamas, IDC Research Director of AR, VR, and mobile devices. Ramon, it is great to see you. And maybe start here, Ramon. As a guy, you've been watching and analyzing and thinking about Apple a long time, Ramon. Maybe to start, I'm just curious to get your take on Tim Cook's tenure as CEO and what grade you would give him, Ramon. I was talking yesterday on the show. I had a longtime Apple investor on the show, and he just happened to be in the chair when the news crossed, Ramon. And I asked him for his grade on Tim Cook, and he said A. I would give Tim Cook an A. What grade would you give him, Ramon? What do you think?
That's an interesting thing because, Tim Cook's had, a nice, pretty solid 15-year history. And there's a lot of questions about him coming in following the legend that was, Steve Jobs. But, altogether, I'd have to give him probably about an A- because not everything that he touched turned to gold. I mean, remember those Apple speakers? Okay, you can remember, and more recently, the Apple Vision Pro. And there's a lot of expectations on that. But, look at the products that did come out, and they did, quite well. If you take a look at, the AirPods, if you take a look at, newest iterations of iPhone services, which Dan mentioned, and it's quite a little thing, the Apple credit card, which many people ended up getting. And, that was a money churner. So when I take a look at this, it may not be everything that's, say, tangible in a product because, iPhone still reigns supreme. But if you take a look at all those other services and all those money-making, products and experiences, guess what? Tim Cook kind of really pushed that envelope as far as he could. So for that, I tip my hat to him and of course, wish him all the best in his next position.
Ben Beharin, a longtime Apple analyst, Beharin, he posted something on X. I thought it was interesting. I want to run it by you. He said, Tim Cook will deservedly get a great deal of credit for helping Apple scale into one of the most powerful economic machines in the world. But I think an equally important part of his legacy is cultural, Ben says. His job was not only to grow Apple after Steve Jobs, it was to preserve as much of Apple's core identity, values, and operating culture as possible while leading it through a vastly different era. That may ultimately, he says, be the harder achievement and perhaps his most important one. What do you make of that, Ramon?
There was so many things that Steve Jobs had his fingerprints all over, and that certainly there were a lot of the things that he wanted to emulate. Culture is one of the hardest to do at any time because it's going to take, months, years, quarters, so much, time has to go by for you to say, okay, the culture has been preserved. But, in the process, you take a look at what, Apple has been able to maintain, and a lot of it has to do with, the North Star that it chooses to follow to release, wickedly easy to use and fun products and experiences. And you can see that kind of tracing across from iPhone to iPad to Mac. And people look at these things and say, yeah, it's not just a tool or an experience. It's something that I could really kind of have fun with. And that is, something that Apple's always strive for, to delight its customers, and they've never ever strayed away from that. So I think being able to kind of preserve that over the past 15 years and taking that across to all these other new products, Tim has very much stayed true to what Apple has been.
Ramon, now let's spin ahead because the reins get handed off to John Turnus, and I'm curious what you make of Turnus. Would that have been your pick, Ramon? Does the pick make sense to you?
Well, he would have been. He is my pick. I'm mostly a hardware guy, so I really love to see the hardware folks kind of get their recognition over here. But what makes sense to me is that when you take a look at the the products, even the recent products that have come out. If we take a look at the Apple Vision Pro, more recently the which just came out. And you can pretty much see and safely assume that John Ternus has had some sort of participation in that area as well. So when I put it all together, I think he's in pretty good shape.
What should be, in your opinion, Ramon, his chief priorities?
Damn it, I got lost.
I think we might have lost Ramon there. We'll try to get him back, but we appreciate his time as always. No one's better. Coming up, we hear from the maker of a new documentary about Bitcoin's founder, Satoshi. That is next on Market Domination. A new documentary, Finding Satoshi, is coming out on Wednesday. The film chronicles the investigation of the creator of Bitcoin, Satoshi Nakamoto's true identity. Scott Melker, host of The Daily Wolf, is with a cast member from that film, Puck founding partner, Bill Cohen.
Hey, Bill, welcome. Good to talk to you.
Scott.
I watched this film, man. You blew my mind. Got to be honest.
Wow.
I think I'm a Satoshi enthusiast. Been down this rabbit hole for about 10 years, and this was extremely compelling. So why'd you decide to make this film, Finding Satoshi?
Well, you're kind to say that. And of course, people can see it for themselves tomorrow at findingsatoshi.com. Well, you say I made it. I actually was just sort of, as you discovered, the investigative reporter trying to figure it out. I was approached, I think, 4 years ago, believe it or not. I can't even believe it's been that long, by the director and the producer. Would I be interested in helping them find Satoshi? And as a investigative reporter and as a financial journalist and a former M&A banker on Wall Street, it was just too, it's one of the greatest mysteries of the 21st century. And it was just too delicious an opportunity to pass up. So I embarked on it and started on the journey. And I had no idea it was going to take this long or if we could even figure it out. I think we did. Obviously, there are different views on all of this. And we're very much proud of what we did and happy to have the debate with anybody who disagrees with us.
Quite a few reports of late surrounding the identity of Satoshi Nakamoto, namely Adam Back being named by the New York Times. I personally did not find it particularly compelling, but his name continues to come up and among a series of names. How did you really hone in without giving it away on who you believe may be Satoshi? What techniques did you use to investigate this that maybe others had not thought of before?
Right. I'm definitely not allowed to give it away today. It's available for everybody tomorrow. Look, what I say about, first of all, I have an unbelievable amount of respect for John Carreyrou, who did the investigation at the New York Times. I mean, Bad Blood is one of my favorite books. He's one of my journalistic heroes. So I certainly, even though I was in Peru when that story dropped and I had no idea it was coming, I read it with great interest when I got back. I would say, no pun intended, I would say with Adam Back, look, I think it's the right church, but wrong pew, so to speak. I think he was one of the 5 finalists that we had to seriously consider when we were thinking about who Satoshi would be. But ultimately, we rejected him relatively early in the winnowing process. And so, I respect John a lot, and I know he put a lot into it. We reached a different conclusion. I think we're closer to it. I hope we're right, but we will see. One of the things that I found so interesting, because before we brought Tyler Maroney in, who's a private investigator, I spent basically a year and a half, Scott, trying to interview kind of like the OG Satoshi experts, or people who I thought would be the Satoshi experts, whether it's the obvious candidates like Michael Saylor or Fred Ersham or Katie Hahn or Joe Lubin or Brian Kelly or Brian Brooks or Bill Gates, even Joe Grunfest at Stanford Law, and basically to a person. What I found so interesting is they were saying, like, Bill, what are you doing, wasting your time trying to figure out who Satoshi is? This is not a use. You're a wonderful investigative reporter. This is not a useful use of your time. You should be spending your time on other things. They were like dismissive, like it's not important to know who Satoshi is at this point. It was, some 12 or 13 years after, he'd written his white paper, and like Michael Saylor said, Prometheus had given us his fire, which was Bitcoin. Why do we need to know who really was the founder of Bitcoin, who was the genius behind Bitcoin? Fortunately, I think, John Carreyrou and others like us disagreed with that line of thinking. And, after about a year and a half, which included, by the way, a 90-minute interview with Sam Bankman-Fried in a hotel room in New York City when he was at the height of his wealth and power before he came tumbling down, none of which made it into the film because he didn't have any good answers either. So that's when we turned to Tyler Maroney, who I knew was a private investigator, and he helped us really get to the bottom of this.
Satoshi, and not knowing the identity is a huge part of being a Bitcoiner and the ethos of the entire space. So now that you think you figured it out and people know that, what are people's reactions in the industry to someone being named, and what are the implications of that?
Well, I mean, we had last week Adam Back being named. We've had other people being named in the past. I think they weren't even close, frankly. Adam Back was at least close. I think it's healthy. I mean, it's good to know who created, for historical purposes, who created the combustion engine. It's probably good to know who the people were for historical purposes who created the internet. And it's going to be good to know for historical purposes who created AI and who was behind that. I think it's good to know who the creators of Bitcoin is or was. And I think it's a healthy investigation. It's certainly a great intellectual exercise. It was incredibly fun and exciting journey to be on. I can't believe it took the past 4 years to do, and to have the movie finally be coming out tomorrow is, of course, very exciting, and want everybody to see it. And I don't think we're wrong, but if we are wrong, then let's have that discussion. I would love that.
Well, Bill, congratulations. It's a Herculean effort, and I can't wait for everybody to see it tomorrow.
Thank you so much for your kind words, and I'm glad you watched and liked the film.
Loved it. All right, back to you, Josh.
All right, Bill and Scott, thank you both. Coming up, I speak to an expert about the risks AI could pose to our privacy. That's coming up next. Public outrage over artificial intelligence has escalated in recent weeks, from Americans voting to ban data centers from being built in their neighborhoods to a man allegedly throwing a Molotov cocktail at OpenAI CEO Sam Altman's house. So how much of this backlash is warranted? To help us answer that, I'm joined now by AI ethicist and author of the new book, Prophecy, Prediction, Power, and the Fight for the Future, From Ancient Oracles to AI, Carissa Valise. Carissa, it is great to see you and to have you here on set. I read an article by you, Carissa, recently. You compared AI to an ancient oracle. What did you mean by that in simple terms?
Well, we've been using predictions since before the Oracle of Delphi to make some of the most important decisions of our life, like whether to go to war, who to marry. And incredibly, we haven't thought much about when we should use prediction. And even though the technology is very different with AI is nothing but a prediction machine. What it does is it takes data it has and projects it onto data it doesn't have. And even though the technology is very different, the political role it plays isn't that different. When you hear tech executives talk about the future, or when we use AI to make decisions like whether to hire someone or not, we're basically using the same thing as the Oracle of Delphi.
So are you saying, Carissa, that AI, okay, yes, it's getting better and better at predicting what we will do, but also it's shaping our future in certain ways? Walk me through that.
Exactly. When AI makes a prediction about people, it often creates a self-fulfilling prophecy. So predictions about the weather don't influence the weather, but predictions about people influence people. So if AI deems someone unemployable, that person will not have a job. But is it because they are really unemployable, or is it because the algorithm is creating the reality it's purporting to predict and then claiming accuracy for it?
So it's almost like, Carissa, and AI would say, Josh, he is financially high risk. Mr. Lender, do not make that guy a loan. But then because of that, I'm in a worse financial situation, and you think, wow, the AI predicted that just right.
That's exactly right. Yeah. So another way of saying it is that there are many ways to make a prediction come true. And the easiest way is not to actually discover the future, but to determine it.
So if that's the issue, that's the tension, okay, so what sort of follows from that? What's the next step, Carissa? Should we limit what AI can predict?
In some cases, yes. So for example, when it comes to insurance, I think we should make predictions at a population level, but not for individuals, in order to avoid bad self-fulfilling prophecies. But in other cases, it's just about being smarter about prediction. Of course, we're going to use prediction, but we should bear in mind that a prediction is never a fact. At best, it's an educated guess. Sometimes it's wishful thinking, often it's a power play in disguise. So we just need to be a lot less naive about how we use prediction.
So there are categories, Carissa, where you would say, let's limit what AI can predict. I mean, would you say it's lending, hiring, policing?
In other cases in which fairness matters, in the justice system or when it comes to giving out loans, I think it's better to have clear and transparent and contestable criteria to what is essentially statistical pattern matching, in which you cannot contest a prediction. A prediction is not false, and so you cannot challenge it. And in some cases, it's better to have criteria that you can challenge because you have a fairer system.
What do you think, as you were sort of researching and reporting and writing this book, which I think it officially hits today, right?
Yeah, that's right.
So as you were researching, what did you think maybe the appropriate role of governments is in all this? Like, do they have a role? Or do you think, Carissa, is the technology moving so fast that it's just actually hard for regulators to keep up?
I think government has a role. And in this case, it's interesting because it's not about the technology. It's about the use of prediction. It doesn't matter whether we use AI to predict, or dice, or an oracle, or a psychic. But in other cases, it's about culture. It's about us being more skeptical about the predictions that we hear, not only from AI, but from tech executives or from people in government, for that matter. So it's partly about how we think about prediction. And in business, it's partly about concentrating more on preparing rather than predicting, and making excellent products rather than trying to discover the future. Being leaders, not followers.
Was this purely academic, Carissa, or did some of this personal? Did you ever see this kind of play out in your own life in any way?
Absolutely. I think we all have the experience, but some of us more than others, in which you face maybe a hiring panel or some other opportunity in which you know people are predicting your failure. And it's about, how do you defy the odds when the odds are against you?
Let me ask you a broader question about AI, which is that plenty of Americans have some distrust about AI. I mean, we actually have like survey and polling now about this. I'm just curious what you make of that, what you make of this backlash.
I think it's justified. I think these systems have been trained in a way that has been broadly unlawful, taking data without our consent, without our knowledge. These systems are also very sycophantic, so they validate us all the time, but they're not truth tracking.
Great job, they say. Great response.
Exactly.
Oh.
You're brilliant. You're a
amazing.
genius.
How'd you come up with that? Yeah, right.
And part of the value of having a conversation with an actual human being is that they push back. They don't agree with you. And that's a great thing. So a good friend is the one who will tell you, no, sometimes you're wrong. So I think there is every reason to be skeptical about these systems. Even though, sure, they can be good for some things. It's not that we shouldn't use it, but we should definitely be critical.
Carissa, great to have you on set, and congrats on the book.
Thank you so much, Josh. Pleasure to be here.
Coming up, we have you covered through the closing bell on Wall Street. Don't go anywhere. That was great, Carissa.
Thank you so much.
That was
Josh.
awesome. Stocks ending the day lower, and our very own Jared Blickery is standing by with all the latest. Jared.
Well, thank you, Josh. It looked a little dicey if you just take a look at the majors. We are in day 15 of a rally, and the Dow, Nasdaq, and S&P 500 are down. So is that the end of the streak? Well, I can counter that in a minute. But first, let me show you the intraday price action. Here is the Dow Industrial. Started the day in the green, ending down about 300 points for about 0.6% of a loss. Nasdaq Composite off 0.6, very similar chart. S&P 500, very similar again. That's down 0.6 as well. The small caps, which have been leading at various times over the last week, those kind of underperformed today. They were down over 1%. But let me point you to some markets that have been absolutely flying. Dow Transports have been hitting records 8 of the last 10 sessions. And I'll just show you what's going on over the last month there. And you can see up 34%. Here's the Philly SOX index. That is the 10th record high in a row, up 25% over the last month. And then here's the iShares Expanded China tech software ETF, IGV, over the last 6 days. It has been up every single day, and that is good for 10%. So tech is doing the heavy lifting here. And if you take a look at the sector action, it's really interesting because tech was barely positive. It's because Apple was down, and that's because NVIDIA was down. But under the hood, things looking good there. Energy, the big outperformer of the day, that was up 1.4%. What didn't work well, real estate almost off 2%, then utilities, industrials, communication services, healthcare, all of those down over 1%. And here's the Nasdaq 100. As I said, a lot of the big guys underwater today. NVIDIA down 1%, so is Alphabet and Tesla. Apple down 2.5% after the Tim Cook announcement, but Microsoft up 1.5%. And if we dig into the software space, you can see another day of broad gains. That's what we've been seeing for these last 6-7 days. You can also see that in semiconductors, AMD up 3.5%. So tech really proving pretty resilient here. And I think I mentioned stocks 15 straight days, and 10 of those last ones at record highs. Let's take a look at the disruption trade, because that was not doing so well today. It was risk off at the smaller end of the spectrum. You can see that in the meme stocks here. But let me dial back to the Dow Industrials, and I'll close on the transports. So you can see a lot of red. The dark red is Merck. That's down almost 4% today. Honeywell down 3%. United Health, though, that was up 7%. So a bright spot there. That was Johnson & Johnson, my mistake. But I want to close on here are the transports. You wouldn't know it from looking at this, but guess what? Car, that would be Avis Budget Group, up 17%, kind of saved the day there because airlines not looking that strong. Alaska Airlines down 5%, American down 3%. So really interesting mix today, but again, tech kind of pulling it out here.
All right, thank you, Jared. Let's dive into the market action with Rob Sloimer, RBC Wealth Management Technical Strategist. Rob, great to see you. Maybe start off on the big picture here, Rob. Just looking at the market, it sounds like what you're saying in this note is we're short-term overbought. Maybe we're due for a pause here, a breather, but long-term trend, that still looks intact. Am I interpreting the chart speak correctly, Rob? Rob, your mic might be muted there.
Oh, sorry about that.
There we go.
I think you got it, Josh. Look, the market trend is still very much intact. It got a little wobbly coming into the end of the first quarter with that 10% correction, but literally over 3 weeks, we've seen the S&P rally 13%, which is just a blistering rally. So I think in the short term, there's not that many timely new ideas, particularly in the leading areas of the market, such as technology. We still like tech and growth stocks in general. Most of those names corrected through Q4 and into Q1 and got fairly oversold from a intermediate term. And I think of intermediate term as being 1 to 2 quarters in duration. So we've got a pretty nice rebound. A lot of those stocks that had been down, had been discarded for all the other names in the market that have been working, have had this big rally. But so I think we get a bit of a short-term pullback. But I think there's probably more upside in the second quarter. And I think it's going to be led by growth. Growth's been out of favor for almost 2 quarters now.
Can I just ask you, Rob, on the SPX, what are the key levels I should be watching here?
Yeah, if you look at it again from a short-term standpoint, it's always difficult to sort of gauge where the upside is. But if you use some extension levels, believe it or not, we call them Fibonacci extension levels, you get into that 7,200, 7,300. There are a couple of key bands there. And so with the short-term indicators getting fairly overbought, be a little more cautious here over the next number of weeks. Let the market take a bit of a breather as it gets into those resistance points. And on the downside, you have some pretty important support now at the breakout highs from the first quarter. That's around 6,900, 7,000 round numbers. And then there's a couple of levels on the downside. I think the really critical level, though, where you want to manage downside risk from a longer term standpoint, are those lows that we just put in around, I think it's 63.17 or so. Those were the March lows. That's a really critical level. That's the last short-term low we have, and that would have to break in order to make that cycle, or at least the uptrend for the market, start to look like it's starting to roll over.
In terms of, you mentioned the sectors you like here, Rob, growth and tech. In tech, any specific names you call out where the charts look interesting to you?
Yeah, look, I think if we think about some of the bigger cap names that have been under pressure for a couple of quarters now, they've ripped over the last couple of weeks, so a little less timely. Apple was down today. We see names like Alphabet having pulled back, but I think the semiconductor space, outside of some of the leaders have gone an awful long way in a very short period of time, but names like Nvidia and Broadcom, I think, still have more upside. The area that I think is the most interesting, though, and I tend to like things that are out of favor, is the software space. And Jared mentioned that there's an area that's been under tremendous pressure through Q4 and into Q1. A lot of those stocks have been left for dead after all the AI disruption trade, but they're deeply oversold. And that also ties into things like the private credit and private equity stocks. They've been hit as well on the back of those software names. So I think there's still potential there. I wouldn't say the whole group looks bullish, but a lot of them are so oversold that I think the whole area could start to rebound. I think the cybersecurity names, and I think they were up fairly strongly today, are probably some of the best looking charts in that space.
On the flip side, Rob, you say defensives and energy could struggle near term. Walk me through that.
Yeah, so let's just think about what happened in Q4 and Q1. Money came out of technology and out of the growth stocks, went into almost everything else. Value outperformed, financials had a good move, and then part of that rebound was also in the energy stocks. And energy had a great run, but they got very overbought from an intermediate term standpoint. So again, think of that as sort of a 1 to 2 quarter time frame, and they're starting to pull back. Many of the energy names have come down to some short-term support levels, roughly around the 100-day moving average. Short-term indicators are oversold, so I think you get a bit of a bounce. You saw some of that today. But in general, I think energy is probably going to be range-bound. Great positive long-term profiles as they broke out of 2-year trading ranges at the end of last year. But I think they need to take a bit of a breather here. So a little bit of a trading bounce, but I wouldn't be piling back into the energy names at this point.
You're also watching the dollar, Rob. I'm curious, what do the charts suggest to you about the greenback?
Yeah, if we look at the DXY index, the US dollar index, it's really just been in a trading range between 100, 100.5 on the upside and call it 96 or 95.5 on the downside. And I think it's just range bound. We could probably make the same comment on rates, but the dollar has pulled back from 100. It's actually retraced a pretty key retracement level, roughly 50 to 62% of that bounce that we had in the first quarter. And I think you're getting a little bit of a bounce. So we have equity indexes overbought short term. The dollar is a little bit oversold short term. I think the dollar could bounce. I think that could put pressure on things like some of the commodities, gold and perhaps copper. So you get a little bit of a bounce in the dollar. It's a little bit of a headwind for the equities. So I think we get a little bit of back and forth here, a lot of churn in the market over the next few weeks.
Finally, Rob, just curious, what are the oil charts telling you, and what are the key levels you're watching?
Yeah, great question. I mean, it's almost an unpredictable market given some of the headlines and some of the geopolitical uncertainty that we have overseas. But if we look at the key levels, really on the downside, it's that sort of mid 80s, upper 80s for both Brent and WTI. You're going to really have to see oil break down below that level to get a sense that energy traders are starting to discount a serious de-escalation in the commodity. Otherwise, we're still range bound, call it mid 80s, low 90s to the sort of 100, 110 level on oil. It's got to get below those mid 80s, I think, in order to signal that energy traders are getting more optimistic about a peace deal.
Rob, as always, great to have you on the show. Thank you.
Thanks for having me, Josh.
Coming up, we check in on the health of the labor market for recent grads. That's next on Market Domination Overtime. With the U.S. labor market cooling, early career job seekers are seeing opportunities show up in different ways than in past years. Here to discuss is Corey Kentenga, head of Economics Americas at LinkedIn. Corey, good to see you. Maybe start off actually big picture, your thoughts on just the broad labor market, Corey, because you say here it's cooling, not collapsing. But why is it cool, Corey? Walk me through that. And do you expect those trends to persist, Corey, through the remainder of the year?
So right now, the labor market is cooling because we continue to see hiring slow. Hiring slowed a bit so far this year, and it's down over 20% compared to prior to the pandemic. So as long as hiring keeps slowing down, that's going to continue to slow down the labor market. That doesn't necessarily mean that the labor market's going to collapse, that we're going to see unemployment above 5% or, God forbid, 6%. It just means that the opportunities are becoming scarcer to come by, and that makes it more challenging, particularly for younger workers and new grads.
Corey, Kevin Warsh was testifying on Capitol Hill today. If the Fed cut this year, Corey, would that help the labor market?
Potentially, it could put a floor under the labor market, but I don't expect it to make much of an impact. There's already some expectation in hiring plans that the Fed will cut rates a bit, but unless they cut rates down significantly, which would likely be a bad sign, they would probably only cut rates really aggressively if growth was severely threatened. I don't think that we're going to see Fed cuts that are aggressive enough to really change the direction of the labor market.
I was struck, Corey, by the data for entry-level workers that you all had, because it sounds like they are feeling the squeeze here. Hiring is down more than 20% versus pre-pandemic, nearly 40% from 2021 peaks. What is going on with entry-level hiring?
So their trends are following overall hiring. We saw this really sharp dip during the pandemic, this really big rise when interest rates dropped to zero. The federal government was pumping money in the economy, and we've just had a really big reversal since then over the last 3 years. Once rates started to go up, hiring started to slow, and it's been slowing ever since. So we are looking at the cumulative effect of hiring having slowed down for 3 years. So we're way down from the peak. Workers feel that, entry-level workers in particular, because while hiring is slow, layoffs are also low, but entry-level workers, new workers don't benefit from the fact that they aren't being laid off from a job that they don't have.
All right, so entry-level workers, a bit of a squeeze there. I guess, Corey, let's say I'm about to graduate from college, right? Maybe I'm listening to this right now. Where are the opportunities, Corey? What does your data show? Which sectors, which industries?
So we're starting to see a bit more pickup in those areas that were hit really hard in 2023. Technology, for example. Technology, information, media was hit really hard. We're seeing younger workers finding more opportunities in that space. And when you look at the kinds of jobs where new grads have found new opportunities in LinkedIn's Grads Guides, it's in those areas that are really focused on operational efficiency, sales, business development, anything related to revenue growth certainly has some momentum for young grads at the moment.
One thing you also emphasize here, Corey, is skills. Skills matter, maybe more than titles, I guess. What do you think some of the most valuable skills are right now in just the modern American labor market?
Well, the number one job right now is AI engineer. We can't all be AI engineers building and maintaining AI tools, but having aptitude and literacy with those tools is likely to be an essential component of a lot of our jobs going forward. So getting a head start there can potentially give you an advantage. So AI tools, anything related to those bread and butter skills that aren't necessarily technical, communication, executive communication, persuasion, being able to present things concisely and clearly. Those are all skills that are essential for most jobs, and they're not going to be automated away in the future. So being able to demonstrate having those core skills that often come a lot with experience, if you can do that when you're young, that gives you a big leg up.
You also highlight how opportunity kind of seems to be clustering in certain cities. I see San Francisco on here, Orlando, Atlanta, Charleston, Tampa, Austin. Why those places, do you think, Corey? Any kind of common themes, trends?
San Francisco, it's a recovery. San Francisco got hit really hard in 2023 when tech slowed down and has been recovering over the last 3 years. So entry-level workers are finding more opportunities there. The rest, it's the Sun Belt. The Sun Belt is really what has been driving the labor market forward. Even though we don't see a lot of momentum in the labor market, where you find it, it's all in the Sun Belt. Orlando, Tampa Bay, of course, Austin has a big tech boom. Other areas like Dallas, Charleston, all of these cities in the Sun Belt have had a lot of momentum over the years. Nowhere more has had more momentum in our data than Miami, Fort Lauderdale area, where hiring is actually on pace or even maybe above what we saw prior to the pandemic.
So I'll end here, Corey. Maybe bottom line, I'm watching this. I'm about to graduate college, get that diploma. I ask you, Corey, okay, how do I set myself up for the best chance, the best opportunity to land that job? You say what, Corey? What's your best advice, guidance?
1, do your homework. Do your research. Know where there's a lot of jobs available in places like healthcare, and know where there's a lot of momentum, where things are actually moving forward. So anything related to AI or areas where they're tied to AI build out like construction. So do your homework is number 1. Number 2, know what's required of those roles increasingly. What skills are on the rise? Check out LinkedIn's skills on the rise list to see not just what they want right now, but what they're increasingly wanting, what employers are looking for going forward. When you find yourself in the labor market, getting into the labor market the first time, you don't just want to go where there's big opportunity. You want to go where there's growth. So focus on those areas where there's growth. And most importantly, that first job does not have to be the end all and be all. It can be a stepping stone to something greater. So just keep in mind that the steps you take, they don't have to be big, but they have to take you in the right direction.
Corey, as always, great to have you. Thank you.
Thank you.
Well, the share of Americans who are confident that they can retire with enough money is at the lowest level since 2017, according to a recent survey. And the anxiety this could create is leading to poor health. Yahoo Finance's Carrie Hannon is here with all the details on this. Carrie, so the headline of your new story here, money worries are now hurting Americans' physical health. What is actually happening here, Carrie? What is driving the stress?
Yeah, Josh, this is really interesting. This study from the Employee Benefits Research Institute looked at, comparing how people felt about their financial wellness and then how they felt, how their physical health was, both physical and mental health was. And yeah, it's a noticeably dropped in both cases, how their confidence about their financial wellness and their physical wellness kind of moved in tandem. And that was in the downward direction. And that's not good. And I think a lot of this stems from the actual pressure of rising expenses. And I know we talk about this a lot, Josh, but it's pervasive, it's deep, and I think just the sheer cost of living is really getting people extremely concerned. And financial stress just correlates to physical health. And I think I certainly understand how that can happen, just worrying, not eating, not taking care of yourself, and all of those things.
You do note 6 in 10 Americans feel confident about retirement, 6 in 10, but that's falling. And I guess my question was why, Carrie? And is it the cost of living variable you just raised there?
Yeah, Josh, it is, as I mentioned, it's the cost of living. But when it comes to retirement confidence, there's a bunch of other variables that people kind of toss into that when they start thinking about how comfortable they feel about what it's going to be like at this stage of their life. And some of the other big ones are, and you get this one, debt. There is just mortgage debt, credit card debt that both Americans who have not retired yet and those who have retired are grappling with. So they've got rising debt. They have worries about, is Social Security going to be there for me? Or is it going to be less, the benefit's going to be smaller than it has been in the past? They worry about out-of-pocket medical costs. And I think these are really concerns that the uncertainty about the future. So it's present day worries as well as looking down the road a bit and trying to get a feel for what this might look like.
Does a lot of this, Carrie, what we're talking about here, this stress, this anxiety, does it depend, Carrie, and vary a lot on income level?
Yeah, this report showed that there was a striking difference depending on the income level. And so people who made $35,000 or less tended to be report themselves in poorer health and lower financial wellness and more less confident about retirement. And those who were above 75,000 or above were much more optimistic. So I think this is not hard to understand why that would be the case. But I do think for retirees in general, there are, the costs about, rising healthcare, the uptick in medical costs, even travel costs have gone up, Josh, as you and I talked about recently. So I think there's things that people really are worrying about today that impacts how they feel about their finances and their health.
Finally, Carrie, let's say I'm a retiree and I'm watching this and I'm listening to this, and hey, I'm feeling stressed. Are there some just kind of simple, practical first steps they could take, Carrie?
Yeah, this is like, budgeting 101, right? Really try to get control of your expenses. Take a hard look at them. Is there a way that you can kind of get yourself lean and mean? And that's a really important first step is just what's coming in, what's going out. How can I get a little more financially fit here? Talking to a financial advisor, if that's in your wheelhouse, I always advise that. If you can get an unbiased person to come in and look at your overall financial health and wealth, you're going to get a better sense of what you might have. And maybe there are things that you're not considering that are part of your holistic financial picture that you're missing. And so this is a way to kind of get someone to give you a good unbiased look and look if there's ways that you might be able to earn somehow. I know that a lot of people retire thinking they're going to continue to work in retirement. That often doesn't work out for them. But see if there is something you could do just to bring in a bit of, income as a safety net.
Carrie, as always, great to see you. Thank you.
Great to see you.
Coming up, we got earnings from a slew of defense companies this morning. We're going to dive into that sector coming up next. Stay tuned. Hello and welcome to Asking for a Trend. Trump just extended the ceasefire with Iran as the country readies a proposal to potentially end the Middle East conflict, saying in a post on Truth Social that he has directed the military to continue the blockade until their proposal is submitted. Yahoo Finance's Julie Hyman and Jay Conley spoke to the chief economist at Rystad Energy today about the outlook for oil prices amid the continued tensions. Stick around. Much more Ask for a Trend still to come. Ongoing geopolitical conflicts driving demand for some of the major defense companies. RTX raising its outlook amid growing demand, while Northrop Grumman reaffirms its guidance on the heels of a deal with the Pentagon. Here to dissect the sector, let's welcome in now Tony Bancroft, Gabelli Funds portfolio manager of the Aerospace and Defense ETF. Tony, great to see you, especially on set. Let's start with earnings, because I know you're a fan of RTX. They report results. They raised their full-year adjusted EPS and sales forecast. What did you make of the print, and why do you think investors weren't more excited, Tony?
Yeah, I think there's still uncertainty around this war. I mean, obviously global travel overall is up, but obviously in the Mideast over the last month, it was down quite a bit. Mideast is only, 5 to 10% of global travel. So it's not a big issue, but it's everything on the margin. I think there's some fear of jet fuel shortages, obviously, in Europe. There's been a lot of discussion of that. And just higher energy prices. People probably worried it's a little bit of a lag effect. There's going to be some downrange, 6-month lag of potentially, ticket sales. And if that slows down, then obviously, Raytheon, GE obviously reported today as well. Those are the biggest commercial aftermarket engine component suppliers. So, less traffic means less sales of parts. That's probably the biggest factor, is my guess.
Northrop Grumman, they reported. I'm interested to get your take on that report too, and what do you think explained what looked to be some disappointment?
Yeah, it's weird. This whole the sell-off in defense with this Iran war. Again, probably there's a lot of uncertainty, but I think if anything, the reality is it illustrates the need for these exquisite weapon systems, these defense intercept missiles, which, Northrop Grumman, Raytheon, obviously GE has a part of that. They make components in that as well, amongst other of the defense primes. I think the reality is we're going to need a lot more of them. In the first week of the war, 1,000 Patriots were expended, PAC-3s were expended. I mean, that's a big number. And we have 5,000 supposedly somewhat in inventory. And that's just against Iran. Imagine a true pacing threat, a near-peer threat like a China.
Can I ask you, how long does it take to replenish supplies like that?
I mean, the stat that was put out in the first opening months of the Ukraine war with Javelin, Stinger, they essentially burned through a entire year's supply. The first year's supply. In the first year of the war, they burned through 7 years of production. So, I mean, it's going to take time. I think they just had a report today that the Pentagon says it's going to take 1 to 2 years, along with the defense suppliers, to get rates at this tripling, quadrupling. There's going to be a big capex spend on these primes to build out these facilities that can get 2,000 Patriots a year versus 600 what they're doing now. It's just going to be a big spend. In reality, it's going to have to be probably a lot more than that.
Speaking of the primes, Lockheed Martin, those earnings are on deck. What do you expect to hear there?
I think you're going to see a lot of strength in obviously anything in missile systems. They're obviously a large supplier. The biggest. They have a big the F-35 program, which has done some great work in Iran. The reality is we're going to need more F-35s. We're going to need more stealth jets to deal with the pivot of the Pacific with China. So you're probably, there'll probably, again, be some issues. There's always some growing pains with an updated, upgraded software on the F-35. But I think in the long term, there are going to be a lot of sales there.
Speaking of the war, this headline, Trump says he will extend the Iran ceasefire until negotiations conclude. What do you make of that?
Yeah, I think in these deals, negotiations, they're always messy and they take time. I think in the end game, I think it is a foregone conclusion. I think they're going to have to make a deal. There's probably some disagreements with the leadership in Iran right now and who is in charge. But I don't know if Iran really wants to start up a kinetic war again with the U.S. I don't think it's going too well for them. So I think in the long term, this is going to get fixed, going to get figured out. And the big picture is that, what we talked about, that $1.5 trillion budget.
Tremendous.
And even if we get a fraction of that, it's going to be a huge number. And we got to deal with our pacing threat, which is China. And I think that's really where the puck's going.
On that $1.5 trillion, Tony, I was reading reports. It sounds like a lot of that is going for ships and jets. Golden Dome. In your opinion, are those the right priorities?
Yeah, I mean, I think the United States, I think what we've seen, again, just to see what happened in these opening days, that's really going to be, at a much higher order of magnitude if we had to do anything kinetic with China. It'd be, the defense systems they have, the weapon systems, offensive weapon systems they have are much larger, much greater than Iran, and you're just going to need a lot of intercept missiles, offensive, smart weapons to deal with a threat like that. So I think they're probably in the right priorities. Autonomous, kinetic weapon systems, obviously aircraft, undersea, submarines, shipbuilding, all the things we're going to need for the Pacific.
When you hear 1.5 trillion, Tony, though, does that sound to you, do you hear that and say, okay, that's a peak? Or no, do you say this is multi-year defense supercycle?
I think the reality is if you were just looking at it on a percent of GDP basis, post-World War II and the Cold War era, we were at 6 to 7% of GDP. Right now, we spend about 3 to 3.5% of GDP. So we're still well below our historic spending in a Cold War environment, which is sort of we're coming into probably a new era of Cold War. So I think structurally, the defense budget is going to change, and our federal spending at some point is going to have to sort of go in a different direction, probably more focused on defense.
So let me get your take. As a financial analyst and also as a fighter pilot, I'm interested to get your take. When you look at kind of modern warfare, how quickly that's evolving, Tony. Like how quickly is it shifting from traditional platforms, ships and tanks, to AI, software, autonomous systems?
Yeah, I think it's sort of a convergence. I think there's a lot of, for example, the classic example is Palantir with their Maven system, able to go through a lot of imagery for targeting and essentially mission planning, and use that AI to help the warfighter, to help the F-35 pilot or the F-18 pilot or what have you, to make their mission more efficient, more effective use of their weapon systems. And I think they're gonna work pretty well together, and it'll probably be in some joint venture environment or partnership. And I think the budget, even if we get again a fraction of the 1.5 trillion, that's a huge, bigger piece of the pie for all the operators, the traditional primes, you like to call them, and the sort of the neo primes. You're going to see a lot of.
What would be? I meant to, as you see this shift, Tony. We talk a lot about the primes. I mean, what are the companies, in your opinion, best leverage for that?
Yeah, I think right now, anything that's making missiles is probably going to have a long tailwind on it. The Northrops, the L3 Harrises, Raytheons, Lockheed Martins, and then the sub-suppliers to them, companies like Albany International. They make fins. They make all parts of the missile. Woodward. They also make parts for smart weapons and Tomahawk missiles. There's a lot of small, second, first tier suppliers that are feeding into this huge growth in these weapon systems that are, they're critical. They're going to be critical for our future.
I'm interested. Final question, just get your take. What do you think the Chinese make of this war between the U.S. and Iran? They're obviously watching very closely.
Yes.
Some analysis I've read suggests maybe what the Chinese think is, okay, wow, the U.S., when it comes to fighting other militaries, the best in the business. Nobody can beat them. Insurgencies, maybe it's a different story, but if it's military to military, Uncle Sam comes out on top. But also maybe they think the U.S. also wants to keep things relatively short. I'm just curious, does that analysis sound true to you? What do you think?
I think that's a very fair analysis. I think very, very well thought through. I think the reality is like you said, China's watching. They're seeing how this autonomy is playing out, how the drone defense, they're going to be fully up to speed on how to deal with any kind of counter drone. They're looking at our defense, our intercept missiles and how well they have performed. And they're going to go back to the drawing board and sort of figure out what they need to do. And they've been watching Ukraine for that matter. They've seen drone. Essentially, Ukraine has done a pretty effective job of neutralizing drones from Russia, and now they're sort of the leader in drones. So I think there's going to be a lot of points taken from China from that as well. And the reality is, kinetics. If something's going Mach 5, you've got to make something go Mach 5 to hit it, and that's probably going to play out. There's going to be probably a big need for that in the next war. You could reach out and touch someone from, thousands of miles away or hundreds of miles away. That's a big advantage.
Tony, we've been talking to each other remotely for years. So great to finally get you on set, my friend. Thank you.
Yeah, thanks.
Well, Trump just extended the ceasefire with Iran as the country readies a proposal to potentially end the Middle East conflict, saying in a post on Truth Social that he has directed the military to continue the blockade until the proposal is submitted. Yahoo Finance's Julie Hyman and Jay Conley spoke to the chief economist at Rystad Energy today about the outlook for oil prices amid the continued tensions.
Given some of the president's comments today, did we get any kind of clarity at all? Maybe I know the answer to that question already.
Thank you for inviting me here. Clarity is probably not the word I would use in this circumstance. It's probably negotiation. This is what I would use. That comes with a lot of uncertainty, a lot of red herrings and stuff like that. I would say that we are still in the process of understanding whether a deal will be reached. I do believe that a deal is unavoidable. And the reason I say so is that we are facing the largest supply disruption ever in the history of oil and energy markets globally. If we are going towards a no deal, then we stand to lose 10 million barrels a day of demand, which is 10%, which is a major recession. And I don't think that the world is ready for that. Not the United States, not China, probably not Iran. So I think that a deal eventually will be reached, but they're going to push like every time. There's going to be brinkmanship. There's going to be, trying to extract the maximum possible, and therefore do not expect a resolution until the very, very last minute. So I'm assuming your follow-up question is how far we are. How far are we from a supply crunch?
What's the very last minute, I guess?
So let's put it this way. We have lost 500 million barrels of production, right? So that is close to 10% of the global inventory of oil, which is roughly 7 billion, right? 7.5. It's already an astonishing amount. If we sign a deal tonight, which is not going to happen, but let's say in the next week, then through the process of normalization, when all things are normalized, we will have lost 1.2, 1.5 billion barrels of production in the Middle East. Never seen anything like this before. So first of all, you were showing some prices earlier. My suspicion is that they will need to correct up before they correct down, right? So both the paper and the physical. Specifically the oil products. The oil products had a major downward correction in the past week. I don't think that that's justified. I don't think it's justified. So the refining margins are negative. I mean, the refining margins will need to be positive very soon. So all in all, if we don't have Suez, the Strait of Hormuz reopened, Strait of Hormuz reopened, then we're going to start seeing some demand destruction in the sense that we're going to have supply shortages, starting with aviation, right, all across Southeast Asia, but before long it's going to be in Europe, right? So we're talking about May, right? May, June, the time when we're going to see widespread, systematic kind of shortages. And that is already, in my view, a major source of economic risk, if you think about it, right? That the market is completely oblivious of.
Right.
So the market, the equity markets and even the commodity markets are working on the hypothesis, on the belief that this is going to be solved very soon. I do believe that that is the case, but and I don't trust until I see it, until I really see a deal which is, signed by the United States, Israel, and Iran.
Yeah, let me ask you, Claudio. If we were to, and as you point out, we're probably not going to see that deal get signed tonight. But let's say we were to see a deal get signed, however likely or unlikely that is. Right. What does that normalization process actually look like? How long does that take?
So, first of all, you need to start normalizing the flows in the strait, right? So we, before the war, 20 million barrels a day, roughly, of oil was flowing through that. Most of that is crude, right? But there is a very important component of product, specifically jet. That's why we have all these shortages in Europe and in Southeast Asia. The jet was coming from, for the most part, from the refineries in the Middle East. In order to go back to normal, it's going to take 2 months, right? So even if you have something like 2,000 vessels are trapped in the Hormuz, you need to start declogging that. and then you need to start bringing in the vessel from outside. So assuming that it all goes according to, it all stars align, we're talking about 1 to 2 months to normalize the flows. And after you have that, you can start normalizing the production, so bringing it back, right? So, and that is going to be a big challenge in itself, because some wells, you can bring them back relatively quickly if you have high pressure, if the crude is not heavy, and so on and so forth. But in other cases, it's going to take much longer. So the whole process, if we sign a deal now, to your question, Jake, if we sign a deal now before July, August, we're not going to see the pre-war levels of production.
So one of the other things that Trump said in his interview this morning, he said, I would have thought that oil would have been a $200 bill. And he also said he thought the Dow would be 20% lower, 30% lower from these levels. Right. Why isn't it? What's going on?
Well, there is a component that I think that this administration has a lot of quote-unquote currency and credit in the market. So they believe what the current administration, what Trump is trying to do. So they believe that eventually there's going to be a deal, right? Otherwise, otherwise we would have $200 Brent, and the S&P would be 10% down from the pre-war levels, not slightly above. But the point is, the more the time goes by, the less this premise is credible, right? So that we are running up against a supply crunch. Once you start seeing really flights being canceled, not just on some peripheral airport in Thailand or in Italy, but in Schiphol, Amsterdam, right, in Madrid, then this is when there is going to be a reckoning. And I think we're very close to that. So what people don't realize is that this supply crunch is absolutely major. And some of that will come no matter what. Okay, at
this point, it's too late.
At this point, it's already too late. So what we can do right now, if we sign a deal right now, then we can avoid the wars. If we don't sign a deal in the next 3 to 4 weeks, then we're going to see a lot of problems.
Let me drill down on something you put in your note recently that you wrote yesterday. You mentioned the S&P, the Dow, the Nasdaq, they're all at or above all-time highs. And you mentioned part of that is the strength of the tech sector.
Yes.
Now, the tech sector is reliant on helium that comes from the Gulf, aluminum refining capacity that comes from the Gulf.
Absolutely.
Is the tech industry underpricing that risk? Because it seems like it's not something you see people really talking about with tech, and what you hear instead is the tech industry, the AI demand is insulated from this.
Yes, so extremely good point. So I would say that I would look at it from the standpoint of what's in the United States when it comes to the tech sector and what's outside, because the United States comes from a position of strength when it comes to energy. Right, so it's a net oil exporter, big natural gas producer. There's a lot of wind and solar even in places like Texas and California. So when it comes to the United States, is in terms of deploying of capacity when it comes to the data center, almost 50% of the world data of the world capacity when it comes to data center will be in the United States, and the United States has a very strong position when it comes to the energy. So we are not that impacted by the energy crisis, with the exception of the oil price. The oil price is set globally, and therefore it impacts what happens in the United States. But the price of natural gas is actually $3 per MMBTU. It hasn't gone up, right? So when it comes, therefore, the energy, the tech sector that occurs in the United States from the energy feed into the tech sector, that is fine. That, in my view, is fine. The ones that are, so all the data centers that are popping up in Europe and China and India, those are more at risk for sure because of the energy crisis. Yeah.
Claudio, thank you so much for coming in.
Thank you.
Nice to see you in person.
Thank you, Claudio.
Thanks a lot.
Time now for To Watch. Wednesday, April 22nd. Markets kicking off a busy stretch of earnings, including names across energy and tech, GE Vernova, AT&T, Texas Instruments, and ServiceNow. But all eyes will be on Tesla, announcing results for the first quarter after the markets close on Wednesday. Analysts anticipating a quarter that lands roughly in line with estimates. U.S. demand is soft, but stronger international deliveries and continued momentum in energy storage is offsetting some of that weakness. Investors will be listening for any signs that Tesla's shift to a subscription model for full self-driving can support margins, especially as AI and product development costs continue to climb. And with average national gas prices pushing past $4 a gallon, demand signals could matter more than usual. IBM also reporting Q1 results on Wednesday. Analysts expecting strong software growth to offset weaker consulting demand. Company's recent deal activity could start boosting software growth more meaningfully in the second quarter. Turning to Boeing, where first quarter earnings are expected to come under pressure. Company absorbing losses tied to its Spirit Aerosystems integration, weighing on profitability in the commercial aircraft business. Deliveries of the 737 MAX are improving, which could help margins in the long term. Speaking of planes, Southwest Airlines also announcing Q1 results on Wednesday. Analysts forecasting profits to improve, driven by stronger pricing and the rollout of premium seating options. But costs are a big storyline. Fuel prices are rising and labor costs are climbing, both of which could pressure margins. That's a wrap on today's show. Thanks for watching.